Hi everyone and welcome. It's Steve Johnson here, Chief Investment Officer at Forager Funds, joining you for another short weekly video. And I'm joined again by Senior Analyst on the International Fund, Gareth Brown. Hi Gareth.
Hi Steve. Hi everyone.
One of the things I really like about investing in small cap stocks is that sometimes the company specific news can outweigh what's happening in the wider market. We've had a few months where the macro and obviously this COVID-19 disaster has been dominating share prices and news, but we've had a little bit of good news in the small cap part of our portfolio over the past few weeks.
Yeah, so we own shares in a gambling software group called GAN. It's a North American focused business, and you're right there that the micro is outweighing the macro over time, but geez, it's been a bumpy ride. So we bought this stock, most of our stock we bought in February. We're up almost about 70%, I think, off our initial purchase prices and our average purchase prices. But it started off by falling 70% and then rallying more than 400%. So it's been a wild couple of months.
Now, we actually put in an order to buy some more at the bottom. Should we maybe not talk about that story?
Yeah, it's probably not the best idea. We bought on the way down, and then it fell a lot, and we bought a bit more, and then it halved again, and then we tried to buy a bit more, and we quibbled. Basically, it was one of those days.
The best way to think about this, there used to be a company listed on the ASX that called themselves Software for Bank in a Box. So if you wanted to start a bank, they would provide you all of the software that you needed for customers and managing systems and compliance and all of those sorts of things. And I think about this business a little bit similar for a casino that wanted to build an online casino. So if you were offline or you were just starting from scratch, as these states in the US have started to legalize, and you need the software and the compliance and even the marketing tools, you go to a company like GAN or one of its competitors and say, we want to buy this product off you.
Yeah, and the regulatory background as well. I'm not sure if you just mentioned that then or not, but definitely ticking a lot of the regulatory boxes as well is quite difficult in terms of providing these services. So the initial customers here have been big customers. So Flutter, which is one of the biggest gambling groups in the world, they bought FanDuel, which is a fantasy sports league, and which is now one of the dominant players in the real money sports betting market in the US, and GAN provides the back end services for them, and also some larger casino groups in the US. But one of the big growth opportunities for the company is smaller casinos in the US that now have this new impetus to create an online business to engage the patrons that normally visit them on site, also when they're unable to come into the casino.
Yeah, so we could talk about this business for a long time, and everyone keeps telling us to keep these videos short, so we should do that. But maybe just a quick summary of what's happened in the past few weeks, really, that's put a rocket under the share price.
So one of the things that we look for over the years, and we've had some success with, is what I would call geographic orphans. So this is a business that started off it was listed in the UK on a secondary market there, the AIM, which we've had some success in, but it's a off the radar kind of market in the UK. But the bulk of their business is coming out of North America. So the people that should logically be looking at this stock weren't necessarily the people that were looking at the stock, didn't necessarily understand it to its fullest. And by the time we bought, they already had plans to move to a listing on the NASDAQ in the US. They have now done that. So that all the shareholders that previously owned stock in the UK have been transferred over to US stock, and they had an initial public offering in the US. So they added about 25% to their capital base. And that's been the change. So basically we've got a whole bunch of new shareholders looking at the stock and trying to assess the potential for the business over the years.
Yeah, and it's a market that's a lot more liquid, and it's a market that at the moment is very excited, I would say, and knowledgeable about this space. You've had DraftKings list on the stock exchange recently, and that share price has been going through the roof as well. So there's a lot of excitement. It's a bit of a hot space, and this company's done its IPO at the right point in time, I think, to take advantage of that. And we do see plenty more upside here as well if they can deliver what they plan on delivering over the next few years or so.
Yeah, it's definitely worked out well, and it's been an important contributor to performance over the last sort of 6 weeks. But it certainly hasn't been the only stock that's been working well for us. Another one, GMS, which I would definitely put into a mistake bucket, but has been doing pretty well. Do you want to outline the situation there, Steve?
Yeah, certainly the share price. This is a UK listed oil and gas services company that we've talked about a little bit over the years. We actually talked about it at a roadshow that we did a few years back, so some people might be familiar with it. It has been a disaster, as I'm sure wouldn't come as a surprise given the oil market that is out there. But they've had a new executive chairman in there for the past 12 months, and he's taken a lot of cost out of the business. He's done a pretty good job of turning it around and building up the order book. And one of the company's major shareholders has launched a takeover offer on the last day of the month, so the last day of April. So it was just in the NAV at the last day of the month for the international fund. We decided that first offer was too low, but they've come back and increased the offer by another 40% or so. It was trading at 3p prior to all of this happening, and the takeover offer is now at 10. And we've decided to take our losses on that one and move on. So it's been a big positive contributor to performance over the past couple of weeks, but it was a big negative contributor to performance prior to that. It's actually the last of our oil and gas services stocks in this portfolio, both in the Australian fund and the international fund. We've got finding it very, very difficult to see a future for some of those leveraged players with lots of debt that works out well for equity shareholders, given the state that market is in. It's very, very beaten up at the moment. So the value investor says to me, it's probably a space that we should be looking more at, but it's been a very difficult one for us for a long time now. And its future is even more bleak for the short term. We certainly have not.
I sort of feel quite fortunate here around, certainly from the international fund perspective here, that we cut a lot of that exposure well prior to this damaging event. We really only owned GMS before oil got really caught up in it. And I mean, what was the price going back in February? What was the price?
Yeah, it was probably 4 or 5p or something, and a very
so
small.
In effect, our oil stock has gone. Our one oil stock has gone through the worst kind of environment you can imagine, and it's doubled. So at least the end of the tails has been a decent one for us.
Yep. Just across the wider market, I look at our P&L or our NAV in the international fund now, and we're only, I think I say only, but everyone will know what that means in the context of what's happened, down about 10% this calendar year. How are you feeling about where markets are and the opportunity set that's in front of us?
Yeah, I guess lukewarm is probably the right way to put it. I was, I don't know, banging the table is probably not quite the right word, but I felt the need to buy in late March. It felt like a capitulation point in the market. And we were seeing a lot of stuff that was really on the absurd side of cheap. Well, I don't know that I can't say that applied to every stock in the market. I don't think indices necessarily looked absurdly cheap, but there was a lot of individual stocks that just got so badly hammered. And a lot of that is corrected. And it really only lasted a few days right at the bottom there. You sit here and say, okay, we're in a world now where we have this disease that's shut down the economy hard for at least a few months, and probably will be on a go slow for a few years here. And we're only 10% down from the peak. It sort of doesn't scream bargain to you. I think the one offsetting thing here is central banks around the world and governments coming to the rescue and pumping ungodly amounts of money into the market. So we do need to be careful around that, because going to cash might not be the best move either.
Yeah, and I think the market's become much more discerning. I look across our portfolio. We've been, I guess, some of those small cap stocks that have done very well this calendar year for us have offset some of the more cyclical stuff in the portfolio. But I still look at some of those businesses that are very strong balance sheets. We're very confident they're going to survive, but are exposed to economic activity. Ulta Beauty being a good one in our portfolio, and it's still down a third from where it was trading back in January and February. So I still think that there are lots of opportunities out there, but I think you're dead right that the market is sitting there doing a pretty good job at the moment of saying, well, okay, it might recover and it might do very well, but there's also a different future there. And you're effectively, I think, taking a bet on a recovering economy that those stocks are going to do really, really well from here. I think that's probably likely, but it's not as straightforward as I really don't care what happens here. This could take 3 years to recover and I'm still going to do well from today's share price, which I think is a bit of what we were seeing back in the middle of March.
You said something to me a few weeks ago that sort of stuck, and I agree with 100%, which is if you actually sat down and said, you could look forward and see what the effect of COVID was and what the effect would be on the economies, you might have said, down 10 to 20% for the market, that's the right move. If we had gone in a straight line there as this thing developed, you'd say this is perfectly rational. What we've done instead is gone and then come back up. So I think we're probably in a spot where I don't feel like any great need to rush out and buy the index, but I think we're in a market now where individual things can be still mispriced. It's not going to be like it was in late March, but it's a better environment for us than it was in January or February.
Yep. All right, Gareth, thanks for your time. Enjoy your weekend and we'll chat next week.
Thanks a lot.